the traditional investments like fixed deposits and recurring deposits do not allow me to do that. I have to break it. Then only I have to do that. And or I have to open a new FD. I mean, I can't be opening for a 25-year-old goal. I can't have a family of fixed deposits open. That doesn't make sense. When you break an FD, when the FD matures, you have to pay tax on the entire thing. And you are paying tax every year because of the TDS. Whether you redeem it or not, you're going to pay tax on the FD. So you need an instrument where you pay tax only on the amount you withdraw.
And when you withdraw.
When you withdraw, precisely.
So today's episode, Pattu, diving straight into it, is on, it's as old as time, this entire concept of lending somebody money, or udhar as we call in India. There are different names for it, bond, debt, etc., etc. And I don't even know if it's all under the same umbrella, but my sense is it perhaps is, right? It's the most basic concept where here I have some money to give you, you want it, you can take it from me for some time, and when you return it, give me that same amount of money back and some more for all the trouble I took to give you that money, or because you kept it for that amount of times, etc. In modern times, as you just said, Pattu, it's perhaps not such a sexy idea as an investment concept. But what is this entire world of debt about? Would man be able to survive without it?
That's a very deep question. Yeah, so debt is what keeps us all alive. The banks thrive on debt, and the economy depends on the banks. We all know how debt works, but the problem is that when we open a fixed deposit in a bank, we don't often realize that we are the ones who are lending money to the bank.
Yeah.
We make it a point to say home loan, and we make it a point to say we know that we are taking money from the bank. But when an FD is the bank taking a loan from us, but that doesn't often ring a bell that way. So debt is a very complex object, and especially when it is linked to the market. So when it's just two people and I borrow money from you for 2 years, and after 2 years I give you the money back, I pay the interest either in between or after at the end of the 2 years. It's the simplest product ever. But the moment you start saying that in the middle, in between those 2 years, I can take this bond between us, this agreement between us, and sell it to somebody else, the whole thing changes. It becomes much more complex. It becomes more fascinating than equity investments. So that's how.
And are all debt instruments based like that? Basically, when we give them money, we don't really know what they're doing with it. Or are there some debt instruments that are very safe, where we know exactly who's keeping it and for how much time and what use they're putting it to?
So safety is a very subjective thing. So now there are two kinds of risks. One is the risk that you actually see, the visible risk and the invisible risk. Everybody appreciates that the stock market is risky because they can see the price moving up and down, or zooming up or zooming down or whatever. So that's the visible risk. That's actually a nice thing because you know it's risky. I mean, debt is largely invisible risk because everything works until it doesn't.
Mm-hmm.
So to answer your first question, almost always we don't know what the money is going to be used for. Whether we loan the money to the government via small saving schemes, via bonds, etc., or corporates or anything, unless we are actually some kind of investor in a company holding 20%, 10% stake, where we have some say in how the money should be used. Most often, when we use it as a savings instrument, we don't know what the money is going to be used for. There is some amount of trust, but the problem is that maybe I can talk about it later. It's a very counterintuitive thing. The riskier the borrower, the more interest they have to pay. And unfortunately, most people don't see it like that. They only see the interest and, oh, this guy is giving me 10% FD, 12% FD. There's a reason why they are doing that. And it's counterintuitive that a person who is unable to pay or who is not fiscally healthy has to shell out more in terms of interest, which means that that's why they call it the debt snowball. you become more and more entrenched
Yeah.
in debt. So yeah, it's a fascinating idea.
Now, I know this show is entirely about the individual listener or viewer. It's about us. It's about personal finance. It's about saving and investing for the future. But just to take a step back a little and be a little philosophical, as usual, we are on the show. Whenever you go to say an RIA like Vikram, for example, right, and you show him your entire financial situation and there's debt, there's always, in an individual's position, there's always the first intention is to pay that off, clear that debt, right? Um, and therefore, we've been brought up to think debt is a bad thing. Don't take loans. Why? It's, you want to sleep well at night, live within your means, don't take debt. And yet, why do governments take debt? Why do corporates take debt? And how do we make in our mind this world of debt say, yeah, maybe for personal reasons it's not a good thing, but without governments and corporates borrowing our money for debt, we might not have that cushion for risk and volatility.
Yeah, so the government is probably the most unstable. Most governments are probably unstable financial institutions. If you think of it as a company, it's very, very unstable. It can fold anytime. It's just that they have the power to print money or change policy. That's what keeps them afloat. So the situation with most government is that they are spending way, way more than they are earning. And that is the reason why they need to borrow. And some amount of borrowing is always healthy, because you need to create equality in society. You can't leave some people behind. You have to give them subsidies and so on. So that is essential. But obviously this borrowing can become so high, like in the case of Pakistan for now, that their currency becomes devalued.
Right.
So it's a very complex idea. But of course, in the case of corporates, the reason they borrow is to grow. And many of them want to grow in a greedy manner, and that gets them into trouble. But again, it's all about growth in the case of corporates.
So, in essence, from my perspective, debt and fixed income is a great thing, right? I'm very slowly, actually very quickly starting to realize how important it is, right? As you've always said, it should be 50% of your entire portfolio. Now, during the little bit of research I did, Argentina is offering bonds at 26% pattu. I would like to put all my money into that, right? India is offering government bonds at, I think, 7.7%. I did a quick Google search. Did you answer it already? And the difference between these two countries is because Argentina is just way more risky. But then again, 27%, it's so tempting. And you always assume debt is a guaranteed payout, right?
No. You're not going to get your money back at those levels. That is the counterintuitive idea that we should appreciate primarily. So the guy who is unable to pay is expected to pay more. And that's, from a basic layman idea, that's very counterintuitive. The guy can't pay more. If he can pay more, he won't pay. But that's how the concept of risk premium works. So you take a risk and you demand a premium proportional to that risk. But unfortunately, the risk can be so high that the whole country can fold. So take a look at all our neighbors. Sri Lanka is in trouble. Pakistan is in trouble. Bangladesh is not doing so great. India is shining because of multiple reasons. One is its entrepreneurship is growing. We have a stable democracy. We also have a stable economy and a stable currency. All these matters. Argentina does not have a stable currency. In fact, if you look at the Argentine stock market, it is like a roller coaster. Because people in the US, there are traders in the US who dominate the stock market every day. Whereas if you look at the Indian stock market, it has become stable over time. Because more and more participants, especially retail participants, and therefore via them the mutual funds, they have made our economy stable. We don't need these foreign investors, up until 2013, 14, 15 or so. The foreign investors were the guys who were, determining returns in the country. And one more important idea related to debt is we have a huge cushion called the National Savings Fund. all the money that goes into our PPF,
Right.
senior citizen savings scheme, monthly post office RDs, monthly income schemes, everything coming to the post office money and the all the small savings schemes, all that is pooled into one big fund. And that fund is a cushion that none of the superpowers have.
Interesting.
And
Tell
if
me
you
more,
look,
Pattu. I'm very curious now. For
if you
example,
look,
my
yeah,
first question is, how do they keep my PPF amount safe?
see, it is not a question of that amount is not safe. It's not held anywhere. You
Okay.
put in money, it just goes into that ocean called the National Savings Fund, and the government is going to borrow from it. The government is going to take that money and use it to build roads, whatever. They're going to fund their enterprises with that. It is just that when you want it, it will be there. The account will show when you look at take your PPF passbook and update it. It will show this many lakhs, but that
Yeah.
doesn't actually mean that many lakhs is going to be there. I mean, it's a matter of accounting. You
Right.
understand? So, but that's the sovereign guarantee. The guarantee is that when you are ready to close the account and you want to withdraw, it will be given to you. The
Right.
government is hoping that the entire nation will not withdraw at the same time.
Right.
So, which brings us to the Franklin situation later on. But we had
Which we will talk about in detail. But Pattu,
yeah.
why did you, I'm very curious why you said our National Savings Fund is this big cushion for our country, which the superpowers don't have. Why do they not have it?
They only have bonds.
Right.
They only have bonds, and those bonds can be traded. And that trading can cause the value of the bonds to go up or come down, and there's a volatility there. Whereas the national savings schemes cannot be traded. That fund, it's several thousand crores by now, and many investors swear by it, right? And so that is a rock solid component of our economy. Of course, India is trying to deepen the bond market, make more players come in, and so on. And I would say in about 15 years or so, retail investors would be buying and selling bonds left and right. Just like trading has picked up now, especially after Corona, the number of people doing F&O, the number of people trading, it is exponentially increased.
Absolutely.
So that is going to happen, and that will deepen the bond market and make it more stable. So the government can afford to, spend more than they can because of this cushion of the. So this is data. I mean, the source of this is from the economic survey. The economic survey has noted this several times. This is the survey that is released on the day before the budget
Right.
every year, and they have noted this several times that we have this cushion that more. So I mean, I would say things are in a good place for our country, and we should be very proud of it.
But I'm a little worried when you said the government still borrows from it. Are they allowed to invest that money somewhere so that it grows? Because
No,
it does.
they have to borrow, and I mean, of course, the moment you open a PPF, it is automatically borrowing. The government has borrowed that money. The moment you have,
Yes.
so they are free to do
Yes.
whatever they want with it, and they have to lend to the states, and many states are in an extremely poor situation because of their own subsidy issues, and they have been, giving left and right schemes, reverting back to the old pension scheme, etc., etc. So the states are a problem, which is why, if you notice, the central government bond, if it trades at 7%, there are bonds from the state government which trade at 9%, 10%, which that is a risk premium. There is a risk involved because the state already is in a very poor shape. So the higher the interest they offer, the worse their financial situation is. And that is
Right.
true of many cases. RBI said this many times.
Here's another ridiculous question. Please indulge me, Pattu, right? What if you. So it's two part. One is, what if you had absolutely zero opportunity to have debt in your portfolio? You can only do equity, right? What would happen to your current situation? And two, the opposite, you only have access to debt and no equity at all, right? So 100% in both cases. What do you think would happen hypothetically in those cases? What if an investor, retail investor, had only 100% access to one or the other, and which one would you choose over the other?
It is not a hypothetical situation because staunch Muslims who follow the Muslim investing law, the Sharia law, they cannot hold any debt. In fact, I
Right.
get asked this question a lot. I cannot hold fixed income. What are my options? I don't know what to answer, because we do not have, as to my knowledge, we don't have a Islamic banking system in India.
Yes.
So
But
we
it's
don't have
huge in the Middle East, right?
Yes, we don't have Islamic bonds. So we don't have the Sharia compliance in debt. And if you take many funds, if you take, for example, before 2008, I used to tell them invest in arbitrage funds. Arbitrage are fixed income like in risk, but they're tax like equity.
Right.
But they used to hold almost all the money in arbitrage
Equity.
opportunities.
Oh, I see.
Yeah, equity. Yeah, that's
Yeah.
equity. Equity in the cash segment and the corresponding equity in the derivative segment, so that they will have the
Right.
only equity, right? But after 2008, all arbitrage funds became hybrid funds. They hold 36% fixed income up to, which means the Sharia compliant Muslim cannot invest in it. So that makes so they can only invest in gold, real estate, the stock market, of course. So that makes, what that happens is that makes their portfolio extremely volatile.
Right.
And they only have to hold cash in a current account, which does not offer any interest. So that's the problem. So that the 100% equity means you're essentially putting your portfolio in the hands of luck. 100% equity, gold, whatever, everything is like that. 100% fixed income, you are guaranteed to fail because it will not beat inflation. After tax, it will never beat inflation. You can take all the risks you want. If you take too many risks, you will lose your principal. Because that is the problem in debt. If you make a loss, the loss is almost always permanent. If the borrower has defaulted, that's it. That money is essentially gone. Nobody will touch that bond. In equity, if it falls, you have an opportunity for it to move up. Because you have a basket of stocks. I mean, if you hold only one stock, then it is dangerous, obviously. But if you have a basket of stocks, then you are in reasonably good hands. So those are the extremes.
Which one would you choose?
Neither. Thankfully, I have the luxury to choose a 50-50 kind of portfolio.
Right. It's so interesting, about perhaps want to delve in deeper into why, Muslims are not allowed debt, etc. But I guess it's from the basic idea of them thinking borrowing and lending is perhaps frowned upon, right? I think that's the entire basis of it.
Yes,
And perhaps, go ahead.
The whole idea of compound interest was frowned upon in the previous years, probably in the last century or before that. The whole idea of interest gaining interest, that was considered to be devilry. So they didn't like that. Many cultures banned compound interest. They only gave simple interest. And so I think it stems from there. I think it's considered evil to take advantage of another person. I mean, we are not experts on religion, but
yeah. What about an individual who has a fantastic salary and can put away, save twice as much as he's spending every month or she's spending every month? Then debt may work, right?
It may work until it doesn't. I mean, if the income suddenly stops, then those are the kind of risks that you take. I mean, there are many people, in hindsight, you can say, I have never invested in mutual funds. I have never invested in equity. But that is after 20 years of earning. They made the wealth. But you can't do that when you're starting out. That is a big risk. And they themselves could have made a ton more money if they had invested in equity. So
got it. Pattu, I love these discussions and the directions they take. I'm looking at our timer and it's already past 18 minutes. And so perhaps we should dive into the entire meat of the matter. The listeners must be wondering what we're up to. But yes, what are the different debt instruments available to an investor today? How do we start breaking down this world of what our opportunity is? And perhaps to give you some kind of train of thought that I'm leaning towards is, remember when we broke down mutual funds, right, in the masterclass? From 800, you brought it down to literally 5 or 10. If we could try and follow that same train of thought, or maybe we don't, maybe debt is different, but over to you.
Yeah, so fixed income options has increased in India recently. It was always a very strong part of our culture. The most common is the post office saving schemes or the small saving schemes. Of course, you don't need to invest only in the post office. Some of these are available. PPF and senior citizens are available in the banks as well. And then there are bank fixed deposit, recurring deposits. And of course, the good old LIC policy or the endowment policy, they're also fixed income, but fixed income with middlemen involved, which is why their returns are low. So those are the traditional opportunities. Now, then there are chit funds. These are done by the local societies. They'll borrow and amongst a small pool of people and give money back and so on. It's risky if you don't know who
It's
you're
got a
taking.
very negative shine now because of the entire Sahara situation, right? So
I'm not
I
talking
didn't
about
even
that.
know they exist. Do they exist for people like us? And are they regulated?
There are the small communities still do it.
Right.
My mother used to do it. It's a very small thing. One guy in the office would start,
Okay.
and the employees would come in, or one guy in a society would start, and then the members would come in. Those are still very strong. The corporate chit funds, the chit fund as it's called, that has lost its sheen because of several defaults, people running away, with the money and so on. So I'm just saying, as an option, it is there, but of course, one should properly stay away from that.
Can you delve a little bit into how it works very quickly? And is there an online version of it, or is it all done on trust and literally cash?
I hope there is not an online version of it.
Imagine that.
I think, there are some details which escape me. It's just that one guy says, he pulls in money and he says, I'll give you double or 1.5 times after a certain period and so on. You can also borrow from it. It's just a pool of money, which
So
after
everyone puts in, say, 10 rupees, 100 people.
something like that.
And then when you want it, you take it out, or are you guaranteed payouts?
You are guaranteed payout if you wait the whole term, or you can borrow from it in the middle for a slightly lesser return or something like that. It's something like, it works like a bit of like an overdraft. You can borrow and they will reduce the interest rate a bit and so on.
How does 1,000 rupees grow? Like, what do they invest it in?
It doesn't grow. It's a saving instrument. It doesn't grow. It doesn't compound in that sense. It's just for small term, you have 1,000 rupees and make it into 1,500 after 6 months or 1 year kind of thing. I mean, I'm not very familiar with the chit fund business, and I'm happy I'm not, but that's from what readers have told me, that's how it works. Some people swear by it till date. They still do it. They say, I made this much return. I have a chit fund calculator in my website somewhere in my archive. And
really?
I have shown people it doesn't work like that. I forgot all about it, but yeah, it doesn't
Busting
work.
myths since 2000 and when? Part 2?
I don't know. I've given up about that. There's too many people to fight against. So
Right.
that's that. And then we have this new age borrowing, this peer-to-peer lending, where you have some kind of middleman which connects the borrowers and a pool of lenders, where you don't lend to one person, but you have a pool of pool of borrowers, excuse me, one lender or a pool of lenders connected with a pool of borrowers, I should say like that. And there are other variants of this, but these offer, you can see the ads, they offer 10%, 12% returns and so on. And they claim that the collateral is, there is collateral involved in the borrowing, but it's not easy to, suppose I default, you give me money and I default, and I say my house is on collateral. How long would it take for me to sell the house, give you the money back? It will take time. It will take maybe even years. So there's time is money, right? The moment you lose time, you lose money.
Yeah.
So there are huge risks in it. I would say, as a thumb rule, anything above the SBI, HDFC, ICICI Bank FD rate is risky.
Wow.
These are the too big to fail banks. The RBI themselves has gone on record saying we will not allow SBI, ICICI and HDFC to fail. So which means that they can happily give you low returns on their FDs. And anything above that is some guy trying to capture market share. And by doing something unreasonable, maybe. So I would say stay away from anything else. So that is, I mean, there are other kind of fixed income options, but these are the main ones. Of course, then the debt mutual funds, but I'm talking about direct
Exactly.
options.
So personally, Pattu, PPF has always been part of my life. Thanks to my dad, he literally dragged me one day when I was, I don't even early 20s, and say, no, you're starting this. You're going to put money in this, etc. And I bless him. Before I knew it, now if I look at it, it's quite a corpus. Without me even feeling the pinch, that's the beauty of PPF. I always tell people, right? Uh, and then when I could, I started putting 1.5 lakh just blindly, not even thinking about it. Perhaps I could have invested it better in another place. Perhaps I would have had more to show today, but it's a nice feeling to know that that is safe. It's always there, and at least adds a little bit to my percentage of debt in my portfolio. But I guess today's episode should slowly steer towards the debt mutual funds. But is this a good time to steer towards that? And then,
Yeah.
of course, while I'm on call with you, I'm going to try and go to the platform I invest on, and I literally type in debt, and the amount of options that pop up. Pattu, of course, there's an entire list of liquid funds, right? Then, of course, each fund has its growth and IDCW option. Then from liquid, it goes to something called bond fund. Then you go to a savings fund. You go to floating rate debt fund, etc. I mean, the options are plentiful. So how does one look at this entire world, and which debt mutual fund is the best for whom, at what stage in life, and how would you break down this world?
Yeah, so that's a long ask. So I think first, I think most of us don't understand how the debt fund works, and we should understand that first. So I think we will talk about what is a debt fund in very simple terms,
Sure.
and then talk about what to choose and so on. As usual, we will be getting rid of most of those categories and just focus on maybe 3
Exciting.
or 4.
Nice.
Yeah, that's all.
And let's do the reveal on the next episode coming up next week, Pattu. But perhaps as a last question on this episode, may I ask you, why do we need debt mutual funds? What are the benefits?
Yeah, so the moment we start investing, we've always said you should invest with a goal. Don't invest without a goal, because that means you're just going someplace without any direction. That means you have to think of yourself as a portfolio manager. You're not just some guy putting money in XYZ, getting this much return from this and so on. So you are a portfolio manager for your dream. And you've been given the responsibility, unless you outsource it to somebody like Vikram, a fee-only planner, you've been given the responsibility of achieving your dream. And you need a portfolio, and we said typically a person would need a portfolio of 40 to 50% fixed income, earn the rest in equity, or adjustments thereof can be made. So you need to keep an eye on your asset allocation first. The first thing you should look in your portfolio is not your investment returns, but your asset allocation.
Wow.
So every year when you review it, and you should review it only once a year, more frequent than that is typically not necessary. When you review it every year, how has your asset allocation changed from what it was last year? So if you started with 50-50 and today, let's say it's 60% equity and 40% debt, we have talked about rebalancing in great detail. We should reset the asset allocation back, which means take 10% from equity and put into debt, or vice versa. Which means I must be holding instruments that allow me to freely take a small chunk of money out and then put it into the other, and vice versa. The traditional investments like fixed deposits and recurring deposits do not allow me to do that. I have to break it. Then only I have to do that, or I have to open a new FD. I mean, I can't be opening for a 25-year-old goal. I can't have a family of fixed deposits open. That doesn't make sense. And also, when you break an FD, when the FD matures, you have to pay tax on the entire thing, and you are paying tax every year because of the TDS. Whether you redeem it or not, you are going to pay tax on the FD. Whereas, so you need an instrument where you pay tax only on the amount you withdraw.
And when you withdraw,
when you withdraw, precisely. The taxation rule is the same from 1st April 2013. Both the FD as well as the debt fund are taxed as per slab. that is fine. But the amount that is taxed will be lower in the case of debt fund because of smaller withdrawals and because of the delay in withdrawal. So that is the deferring of the tax. And that is, the taxation is always the tertiary thing. The primary thing is I can withdraw at will and I can invest at will. And that is why I need a debt instrument, because I needed to manage my portfolio for my dream.
What a great answer. I'm sold, Pattu. And I'll be completely honest, I don't hold a single debt mutual fund to this day. Perhaps this episode will change everything. And I've been dying to do this episode because I just don't know enough about debt mutual funds. And as Pattu says, we're convinced about the reason why we need them. They're such an amazing tool. It's almost like liquidity in investment strategy, right? It's a weird concept, but that's what it is. It's ease of rebalancing and all of that. And I hope you listen to the next episode on Let's Get Rich with Pattu, because Pattu is not only going to tell you how debt mutual funds work, he's also going to break it down like we did for equity mutual funds into the most valuable and the most sensible ones that you can invest in. All of this next week. Pattu, thanks so much. See you soon.
Take care. Bye.